Hi, good morning, everybody. Thanks for joining us on Crop Hour today on this Tuesday. We will get started here pretty soon with Jack Davis. Just want to introduce myself. I'm Laura Edwards, the state climatologist out of the Aberdeen Regional Extension Center, and I'll be your moderator for today. For those of you who haven't joined us before, I put some notes in the chat there. So we do have a Q&A, a question and answer tab there at the bottom of your screen where you can ask questions of the presenters. We will hold questions till the end of each presentation. We have two presenters today, just to make it easier for the presenters so they don't have to watch the chat and the Q&A while we're in the middle of the meeting. We will show a QR code for those of you who would like continuing ed credits for your CCA certification. We will share that QR code after each presentation today. And if you have any technical difficulties, there are a couple contact people there in the chat as well that you can reach out to. Hopefully the Zoom window is familiar with most of you, but if not, there is that Q&A function and the chat function if you want to chat with the hosts and panelists as well. You should be disabled from using your microphone or camera as an audience member, so please do use those chat or Q&A functions. So today we have two presenters. Topic today is business management. So we have Jack Davis first as our crops business field specialist based out of the Mitchell Regional Extension Center. He'll be our first presenter today, and then we'll follow on with Dr. Matt Diersen as a second presenter, who you guys see on the screen as well. Please let us know if you have any, like I said, questions along the way. And Jack, I think we'll start with you today, right?
Okay, sounds good.
All right, go ahead and launch your presentation.
Make sure it gets. Oops. There, that should be decent for everybody to see.
Yep, looks great. Thanks, Jack.
Okay, well, I got titled Looking for Profits in 24, and boy, it kind of beat it up in February on the price side. And of course, input prices don't come down quite as fast. I got some stuff prepared to take a look at the program sign up and some deadlines coming up there, and then kind of move into some price stuff and a little bit of financial things. If I don't have stuff that you're interested in, you can just ask questions and we can discuss, even if it may not be on some of the slides. So we'll go ahead and get started. There's contact information set out of the Mitchell office, so you can either call there or my cell phone. Email's probably an easy way too, and that's just our names at sdstate.edu. So, of course, it's sign up time again for commodity title choices. The big choices: price, loss coverage, or PLC. You all are probably pretty familiar with that. That's when prices fall below the reference price, you get paid. And then ARC County or ARC Ag Risk Coverage, and I'll just go over ARC County today. There is an individual one that is a little more in-depth, and for some that may fit, but you sure want to take a look at those and get that. The deadline is March 15th. These are things you really don't want to just let pass because it can provide maybe some extra support if we really fall out in price. Effective reference price has gone up to 401. Under the last time frame that you signed up, it was at 370. The effective reference price was the same as the statutory. Well, due to higher prices the last few years, that average has moved up. And for on corn, it's at 401. Beans is 926 and was at 840. And for wheat, it stayed the same as it was. No change there. And then the other thing we're looking at are our benchmark price for corn and soybeans is up compared to what it has been recently. So kind of coming back into a point where it may provide some support or may trigger those. PLC provides more coverage with larger price declines. ARC provides revenue protection for yield and price, but it is capped at 10% of benchmark. And this, I just did some rough estimates. This cap would range from probably around $65 to $100 per acre in South Dakota, depending on what county you're in and what county yields are would be the big factors there. So a choice for PLC would be if you expected prices to go down below where you're going to reach that cap, then you might want to choose PLC. The other thing to think about is if SCO, supplemental coverage option, has been working for you, then of course you know that you have to use the price loss coverage. But those would be individual things to work with your crop insurance agent and your individual farm. So just switching, taking a look at this is new crop corn, and it's a daily close. I started June 1st prior to the year of expiration and then end on December 1st of expiration. And I just did a comparison year here. So the green is 2024 and this is 2014. But in 23, it had the futures paralleled 2013, very close. So I thought, well, let's take a look at it for 24 and see where those kind of end up. Just taking, let me get a highlighter here or a pointer if I can. Can I do that? A laser pointer. So if we just took this low to this high from 14, it's about a 16% increase. And if we say that we're in at the low here at, I think that's right at 461, whether that's our low or not, we don't know, but just using that as an example. And if we followed or tracked that, a 16% increase would get us to 534. You know, it's got a lot of hurdles to make that, but and it doesn't stay long as it did in our previous years where we were shorter on our ending stocks. So just something to think about as we're moving into planting time and that maybe higher risk time of year before the crop is made. Doing the same thing, looking at soybeans. Again, start June 1st, the prior year, and went through November 1st for expiration. Again, a little bit above, probably tracking fairly close. Now these were closes as of Friday, so I don't have any of today's movement on there. But yeah, I went back to here and then out to here where the peak had come. That was about a 15% increase. If we would use this as a low, we're looking at 13 and a quarter for a high, adding the 15% from 1153 to with 15% increase. So just maybe some target type things. Again, got a lot of hurdles to work through to get to that, but some things to keep in mind. This just wanted to break down the long-term chart. It would be a daily long-term. So going into new contract each time, rolling over. So it's a continuation. Just broke him down into thirds. You know, we're going to be lucky to we're falling below down into that bottom third. And I think probably the big thing to pick out from here is maybe our expectations can't be quite as high as they were in recent years. So that's really what I wanted to point out there. Doing the same thing for soybeans. You know, we're staying kind of in that middle range. Would hope that we don't fall below the bottom end there in the bottom third like we were for many years here. Principal crop acreage across the United States, about 318 million acres the last few years. And I know they came out with the base acreage, and I don't have that on the top of my head. And we'll maybe get that covered with Matt, but we'll keep going. So just kind of an idea of what total acreage is in the United States. And just looking, this will be kind of the next thing that'll come up after we've had our outlook last week for USDA's longer term outlook. But we'll have our March planting intentions, and I just wanted to show where those fall out for South Dakota. We end up right around 6 million acres of corn, and right around 53 to 55 for soybeans, kind of. And then I also wanted to bring in all hay production, which is probably our third largest crop altogether. That's 33, 35, somewhere in there where that falls out. And of course, we have come off some of those lows. So with corn and other prices being down, probably wouldn't expect as high a price, but that's okay for guys that are feeding, I guess. Now narrowing him down a little bit, taking a look at corn budgets and soybean budgets for different levels of production across the state, which is mostly geographic. And then I threw in some cash bids that you could currently get at this time. I think the big thing here, I wanted to show that the returns maybe aren't there what they were when prices were a little higher. So something has to adjust, either got to lower some of these costs, which is tough to do, and maybe need to adjust some on the rent if you can, or possible. Again, very tough choice to make it on an individual basis, because you start giving up ground, and then it doesn't provide to help cover some of those fixed costs. But I think if we go back into that time frame like we were from 15 through 19, guys got to really watch things close and either get some concessions on rent or adjust your other inputs accordingly. It's just another graph showing return to land. And of course, if our rent is above these, then we're don't have much for profit to return back into the operation. I picked out like the top 5 or 6 costs here, and when these percentages are as a percent of gross, and this is for corn. That's where the most information is. So I take a line item, so seed divided by gross sales on the corn. So in 2013, seed took a jump from about 12% of gross to 14%, and it remained above that until 2019. Now, in 24, this was done a little bit earlier. Prices were higher, so that came out a little bit lower than it had been in recent years. Fertilizer, of course, increased to about 17%, and really went high, of course, in 21, 22. It's come down a little bit, but kind of anticipating around that 18% for a fertilizer cost as a percent of gross for corn. Here's our land cost, around 30% in 14, finally adjusted lower in 20 and 21. I would guess that it's probably come up in recent years, and depending on when rents got negotiated or how much got negotiated for 24, could be in that 25 to 30%. It's really tough unless you're in a really consistent producing area of the state to maintain that 30% of gross on corn ground. A lot of the high profit ones farms run that around 22 to 25% of gross in corn. Machinery has another cost that's really taken a jump both in repair costs and if a guy is trying to replace some worn out equipment, those costs have really escalated the last 2 years, probably up about 30 to 50%. And I would look for it as a percent of gross to be around 20% in 2024. Our management fee, that sometimes a guy can control that or make some adjustments there. It tends to go up as our gross goes up. We make some more off-farm investments. We spend a little more on maybe a vacation or whatever else we're spending on. We maybe update personal vehicles and pull a little more out for management. But as we head back down, maybe into a lower return level, we'll want to keep close track on that. Interest is in one that we haven't had to pay attention to or not very close. It's probably a couple times higher than it was in 22, 4 to 5 percentage points. So if we're looking at $1 million line of credit for a full year, that's an extra 40,000, and that hasn't taken into account any increase in cost or those types of things. So it's interest is going to start to have an impact as the Federal Reserve tries to curb inflation. Okay. Why did I stop moving forward? There we go. Yeah. Okay. Just had done this a few years ago, and I just wanted to show it because it shows where we went off of the peak in 12, and I have a few slides that look at this. So a lot of stuff going on here, but this is for farms that were farming less than 10 years, and then the 10 plus to 40 years of farming, and just showing where their net farm income, where post peak, and then the amount of drop in those from 12 to 2018. Probably a big one is this operating profit margin. It's just going to get squeezed as we make this shift to larger ending stocks and that through the next few years possibly. Probably another big one is a change in earned net worth. At the peak, we've had a good opportunity to increase that net worth, and even though it's still positive here, not increasing near as fast in the post-peak time frame. So just some things that we may anticipate going into the next few years. So I use the FinBin database, and I use the 4-state area: Minnesota, North Dakota, South Dakota, and Nebraska. In this one, I queried 2,000 to 5,000 acre crop farms for 2022, and then just broke it down into a few of the quintils, low 20% as far as net income, and the upper, which would be at the 60 to 80, and then the high would be 80 to 100%, or the top end. Just picking out a few things. More acres were owned, or a higher percentage owned on the high 20%. Machinery investment went up per acre. So yeah, I just thought that was interesting. Yield was a big factor in the high 20%, both on all of these really. And then of course, price had a pretty good impact. And then operating profit margin, much greater on the high 20%, so very much more efficient. And of course, then their change in earned net worth was much greater. I think probably a big key is this operating expense ratio, and that really just takes operating expenses divided by gross sales again, and that gives a percent. In that, when that's calculated, interest and depreciation are taken out of those operating expenses. It's an easy one to track for operators, and it's worth keeping track of. A guy really wants to probably keep that below 70, and as we can see here, the upper 20% and the high 20% are well below that. And when we got over into the lower, they were above that 70% level for an operating expense ratio. Well, I don't know if it's just slow. Yeah, it's just slow. Working capital is kind of our first defense when things turn tighter. So I just wanted to go through a few slides on working capital. And one way to measure that and monitor it, again, is to compare it to gross sales. So we'd like to see working capital greater than 30% of our gross sales coming up for the year. And if we're looking at taking on a new enterprise or a growth mode, like to see that at a probably greater than 50%. It can help weather through those unexpected challenges if we're taking on some growth or new enterprises. Just looking at them by class, and this is on a per acre basis. Uh, Again, for those farms in North Dakota, South Dakota, Minnesota, and Nebraska. So it really fluctuates, of course, with price and where that is at. Uh, if you have that large inventory of grain and it's stored unpriced, it can make quite a difference. Say just an inventory from 23 valued at 640, got the same inventory at the end of the year, and then I just took today's price cash bid type deal. Not doing anything different. It's about a $300,000 decrease in our current assets. So quality, both price wise and physical, are very important on managing those current assets. And just taking the whole from these farms in the four states, we are quite a bit stronger probably than we are as a nation in this area in the Midwest. We got fairly strong working capital to gross revenue. And this, of course, is at 22. The 23s won't be out for probably another month or so yet. And then sometime we can take a look at those. Well, I don't know why. Here showing, I just took that same group and used the top four. Okay, I switched a little bit. Top 40%. This is on 1,000 to 2,000 acre crop farms, and you can see they're even stronger in that position. They're up around 65 to 70% working capital to gross sales. Where our last slide that was right at 45. And then our low one, low as far as net income goes, not carrying as good a position for working capital. Okay, again, a lot going on, but really just have gross total sales, the operating expenses, and then net income. I just wanted to show, where we were here. This is again 1,000 to 2,000 acre crop farms, top 40% as far as net income. Ran about 800,000 in net income in 2012. We didn't quite reach that peak in 22, but then what I did here, just as a projection, was took the same percentage decrease that happened through this time frame, and then I went out the, those few years. So we can see our peak didn't get quite as high, and then we will probably go a little bit lower, or could, if we follow the same pattern that took place in 14 through say 19. Yeah, here's all the things that you guys face. Just a lot of things coming at you, and when prices go down, it just makes it tighter. Guys got to really prioritize his top three challenges or opportunities. Be specific in choosing those, and that just helps you write it out. I mean, it might be easy to pick 10 challenges, and you don't have to get much detail. But if you start narrowing it down to those three, then you have to think about it more. It makes you be more specific and help you meet those challenges or take advantage of opportunities that present themselves. Something that we haven't had to pay as much attention to, and mostly because of our low interest rates. That 14 through 19 time frame, interest rates were just low, and we could be going back into that type of situation price wise with higher interest rates. So financial management going to be really key as we go through these next few years. To help with that, keep track of that working capital, build that if you can. um, how do we market in the down market? Well, keep track of cash flow. You use the cash flow as a control method. Do a good job preparing, monitor it, compare it to what you had prepared as a budget, actual to budgeted, and adjust as needed. It can really help. That is what I have. And of course, the sun comes up the next day, and boy, it's going to look like a nice few days the next week. But of course, Thursday we'll hear what Laura has to say on that.
All right, thank you, Jack. Great presentation today. I haven't seen anything in the chat and Q&A yet, but folks, please put those questions into the chat or really the Q&A is a little bit better, so we can share those with the presenter. John, if you could share the poll. We have a little poll for you guys in the audience. In the meantime, Jack, I have maybe a quick question for you if you want to answer something while we're waiting.
Sure.
You didn't talk much about wheat there. You talked more about corn and soybeans earlier in the presentation. Do you have any comments on either spring wheat, winter wheat, how the winter's been, what we're looking forward to the spring? Any thoughts on that? As far as prices, outlook, how that plays into the budget?
Yeah, not much. No. Okay, so there, I will still comment. Wheat has just seen that tough decrease, and a lot of it is profitability. Um, there are areas where wheat works very well, or specific operations with the rotation, and not just counting on it for its crop itself, but what it does in your rotation for your corn or soybean yield, and also the reduction in cost due to a breakup of diseases or pests. So it does have valuable benefits. And I know there are very localized areas that still use a lot of wheat in to help with that. Always something to think about. I think I'm a true believer in the soil health practices and things that can help improve, get away from that continuous corn soybean deal. I did try and throw hay in there, so
yeah. I did see that. Maybe
yeah.
Matt will elaborate on hay later
Yeah.
too. Yeah. All right, we have that poll up. Hopefully people have had a minute to respond there. We have one question in the Q&A, Jack, if you want to answer that. The question is, so what would you recommend signing up for, ARC or PLC? That's probably a tough one.
Oh yeah. Now where did I go here? I'm trying. Sorry. Uh, the ARC gives you some what I'll call revenue protection, and that's increased. So I personally, I would lean towards ARC, like this year and maybe next year, but again, keep track of it. PLC is going to kick in when prices go much lower. So we'd have to be below 401 on a marketing year for 24 before PLC would kick in. The thing on our county, we do have a cap. Um, so if prices go low and we get above that cap, then that's all you're going to get. And I listed that cap somewhere from 65 to 100 across the state. You would want to figure where your cap would be in your county and then maybe divide that by your PLC yield. That would tell you where where the effective reference price, the market year price, would have to go to before you'd want to switch to PLC. I did it roughly, and I'm thinking with those caps that I gave, prices would have to fall to 340 to 360 on a marketing year before PLC would be more beneficial. Now, don't take that as a blanket. Okay, got to work it out on your operation. And there's others in the state. I know a few years ago we're using PLC with the supplemental coverage option, and it worked well for them. That doesn't work all the way across the state. It just becomes too expensive the further west you get, and the more variability there is. So again, that's something you got to look at individual. So hopefully that helps. I'd lean, just throwing a blanket, I'd lean towards ARC the next couple of years, and of course evaluate it every year.
All right, thanks, Jack.
Yeah.
We'll transition over to Dr. Diersen for the second half of our morning today. Dr. Matt Diersen, he's our Griffith Endowed Professor on campus in Brookings and our Extension Risk and Business Management Specialist, so our Extension Specialist here. Glad to have you, Matt, today, and you can go ahead and share your screen.
All right.
Looks good.
So look, all right. Thank you, Laura. Thank you, everybody, for attending here today. Just a reminder, if you want some more information from the economics folks, we've got our Ag Economics Dialogues once a month webinar series, and then also additional information goes out on the SDSU extension website. I've got a couple of things to highlight from the ag census that was released last week. You can see here in South Dakota, you got the number of farms. This is as of 2022. You can see the land and farms, the cropland row there, that third row down, 18.5 million acres of cropland in South Dakota. And then during 2022, 17,500, give or take, million acres was covered by some type of crop insurance. So hence setting the stage for the rest of my talk here. And you can see how the 28,000 farmers or farms insurance programs were used on 13,000 farms. And then this really stood out to me. 2022 was not an extreme year in terms of production or revenue changes or price changes. But of the 13,000 that used insurance, 5,000 some received a payment, an indemnity payment, or collected on their insurance, and that payment total was almost $400 million. So insurance can be, it is a valuable tool to consider, and the dollars involved can be substantial, even when it's not an extreme production problem year. So the other thing to highlight from the census was just sort of I did this just to see what was happening. You can see that number of farms producing some of the major crops, corn, soybeans, and hay. As Jack alluded to, hay is a rather, it's a widely widely produced crop. 11,500 farms had some hay production in 2022. You can see corn and soybeans are more prominent in terms of the number of acres. So corn and soybeans kind of lead the way. Hay is from a feed standpoint and a production standpoint, it's a very relevant crop, although it's not as widely sold as corn and soybeans. And I showed there wheat coming in as number 4 in acres and distant in terms of number of farms that raised wheat in 2022. And the other 3 crops, sunflower, sorghum, and oats, I was curious, so I just added those in there. And from an insurance standpoint, all 3 of those crops, flowers, sorghum, and oats, they do have revenue coverage, but it's tied to corn, soybeans, wheat, or in some cases, soybean oil. So it pays to know what's happening with the primary crops that are then augmented with that additional information. Jack mentioned interest rates. I just grabbed some interest rates from the 9th district. So this is ag banks in the 9th Federal Reserve District, so the Minneapolis district. You can see here over the last few years as the Federal Reserve has raised interest rates, the impact on interest paid by farmers to commercial banks has gone from down around that 4% level up to around 8 to 9%, depending on the type. So I've got operating loans and real estate loans overlaid here. That sharp increase in interest is showing up in a couple of ways. It's the higher cost of or higher interest expense will be realized, mainly because of the rate increase. But the other impact, and this is strictly related to or directly related to the crop side of things, would be with the higher interest rate, you've got a much higher opportunity cost for storing grain. So that has a direct effect also on the way to look at old crop. So really pressures carry or requires more carry in the market to keep grains and oilseeds in storage. So let's see what that implies when we look at old crop corn, for example. So here's a snapshot of the corn market from late last week. So you got to get the line straight here. The orange line going through the middle is the futures price, and it follows the axis on the right-hand side here. So a little unusual, but you can see that as you go further out with the futures months, all the way out to new crop. So the far right-hand side there is the new crop corn month. Z for December. You can see that the price increases from the current March contract through the December contract. And with the current interest rate, if you look at $4 corn locally, $4 corn as far as a cash price at 9% interest, you'd need 36 cents of carry to justify storing the crop from an interest perspective alone. So about that amount is in the market at this time. And a quick way to translate that is you need about 3 cents a month to justify storage. So it is increasing, or the higher interest rates is carrying through and showing up in the cost of carry in old crop. The other way to think about old crop is through the amount stored or grain stocks. So here's a snapshot from December 1, grain stocks in storage just South Dakota. I've got the 2023 numbers there just relative to the 2022 numbers. So a little bit smaller crop for both corn and soybeans in 22 compared to 23. So an increase in production did result in a little greater amount in storage, even taking the higher interest rates and interest cost into account. So you can see here for both on-farm and off-farm, a little bit more corn and soybeans in storage. Corn is probably just tied to the larger production level. The soybeans could also be partly explained by regionally a little bit more. There's a little bit more soybean crush, or a little bit more soybeans needed to supply the crush that came online in North Dakota. So expect that to continue going forward. Shifting gears to slightly different crop, the hay situation. I brought this in because, like I said, it is a predominantly produced crop. And we can see here that in 2023, the supply level was much better than in 21 and 22. That's put a little bit of downward pressure on price. And if we take that 2023 supply situation and adjust for the stocks level on December 1st, and then extrapolate out to May 1st, we'd have a little bit better ending stocks situation on the hay side of things, but certainly not back that projected level for 24, certainly not back to the level we saw in 20 and 21 or back in 2015 and 16. So we've still got a relatively tight hay situation locally, and that's keeping or some support pressure underneath prices and limiting cattle expansion. So just throwing that out there as another major crop, and the insurance is not quite the same as on corn and soybeans, but you get the general idea that still got another crop here that's relevant from an overall farm portfolio standpoint. Shifting back to corn, I wanted to take a look at a few of the uses of corn. So this is a chart from the Livestock Market Information Center. They put out a price per or a set of supply and demand projections. So these are their projections for 24 relative to 23. So the last column there is 24, the projected 24-25 crop year. Their estimate for seed industrial, this is going to predominantly be ethanol, is right at the USDA's projected level from the other day from the baseline presentation. So sort of the consensus for ethanol and seed and industrial use in general is 6.8 billion bushels for this upcoming 24-25 marketing year. So that's not a huge story. Ethanol has been profitable, and demand for that, or as a source of demand, that's expected to continue. What is a little bit different, the LMIC, for example, here has a very low feed use or feed and residual number for the coming crop year. The USDA, in contrast, has this number at 5.75, and that would put it, follow Jack's lead here and get a highlighter or a laser. USDA has that number up here at 575. So the USDA is fairly bullish in terms of feed consumption. I think I'd tend to go with the estimate a little bit more from the LMIC on this one, because we haven't seen a dramatic increase in livestock numbers and weight gain or weight levels and such, that would really say that feed consumption in particular would be expected to increase. So USDA has been pointing to lower prices, but that really only has a muted effect in terms of lowering the price, doesn't necessarily translate into a huge increase in consumption or added weight in terms of slaughter weight for animals. So that's a disparity and something that continues to receive some attention. The other aspect receiving attention is on the export side, and here too the LMIC and USDA are kind of taking a slightly different tack. LMIC has it projected at 2.5 billion bushels for the upcoming year, while the USDA only has it down at about 2.1. So USDA is down here. So those two kind of offset one another, or the disparity, exports and feed residual offset one another. You get similar ending stock situations either way, but it's really going to take probably sustained lower prices to continue to move some corn into the export market. How does that sort of play out? Well, if we look at the longer run, ending stocks to use ratio, that's just shown on the bottom axis of this chart, and then the price level shown on the vertical axis. I've got a few sets of numbers here. Way down at the bottom, these blue diamonds across the bottom are the long run or historic stocks to use and price relationship prior to 2007, and then the orange squares on the left-hand side here, that's the most recent 20 years worth of price and stocks to use ratios. And then this set of gray diamonds here is the USDA baseline. So at the moment, we're right here in the middle with this current year, with a stocks to use ratio around 14 and a price of around 480. All the projections going forward from the USDA baseline are these numbers out here, and the 2025 number was a 17.2, followed by a 440 price. So the 2024-25 marketing year, USDA's got it pegged out here. Trouble is, historically, we've never seen a stocks to use ratio that high with prices that high. Much more likely are all these scenarios over here. You go back to ancient history, you're down here. Much lower prices would be historically expected compared to what the USDA is saying will be a continuation of this giant shift in prices based on the current or last year's experience. So seems like a disparity to me as I look at that, and I wonder how that price could be sustained at quite that high of a level with a much bigger stocks to use ratio going forward. So a little bit of a disparity or discrepancy there. Looking more locally, this is just through 2023, where we can see that we had a record level of corn production in the state of South Dakota in 23, just narrowly beating out some of the earlier years from about a decade ago. That record production did put a little bit of pressure on some pressure on basis following harvest, and it's partly responsible for more stocks, but it's also making up for a couple of tighter supply years during the last few years. So increase supply, lower the price, all else equal. What does that meant for price? 21 and 22, South Dakota's marketing year average was above 650 there in 2022. This year, the price was still reasonably high right at the beginning of harvest, but prices fell quickly during harvest and post-harvest here. So currently basis has widened out, and that market year average price, which we extrapolate through the end of the marketing year or through say August of 2023, that factors into that. It's down around 415, 420 right now. And then taking the WASDE price estimate of 440 for the U.S. price for the 24-25 crop year, and adjusting for or backing that up to South Dakota price puts the price right at about 412, 415 again for 2024. So not seeing much in terms of upside potential in corn at this time based on those numbers. Moving on to soybeans, we've got the soybean crush basically estimated out at about 2.3, 2.4 billion bushels. So that would be steady crush domestically and a fairly good source of demand, keeping soybeans high in terms of price level. On the export side for soybeans, both the USDA and LMIC have it projected at about 1.9 billion bushels. So a little bit of an improvement expected in the coming year in terms of exports as production increases a little bit and moves more soybeans back into the global market. The stocks to use and price is a little bit more reasonable, or the baseline estimates seem to be more in line with recent history on soybeans. So here we've got the stocks to use and the price for beans with the current price situation sitting right at 7.6 for stocks to use. So we're right in this mixed area right here. The projection for the 24-25 year is to increase stocks to use to about 9.9, and they're seeing that price hanging around 11.20 at this time. So we're moving back along here. It's not collapsing down like sometimes, but it's not unbelievable or unrealistic. And it doesn't take much of a change in stocks to use, either an increase or a decrease, to move the price a little bit more. Or I would say that the soybean situation, given the an expected increase in carryover, but with the slightly or more inverted market or less carry in the market right now, the market's still saying we need beans, we need beans, we need beans, and that's going to probably keep the sensitivity to supply changes being a little tighter on soybeans, or give it a little more upside potential if there would be a production problem than you've got when you look at the corn situation. In South Dakota, 23. So again, this is just through 2023. They had a good production year, but not a great production year or a record of any kind. But just to show you that we did have a little more increase in soybean production at the state level. And the price impact hasn't been quite as dramatic, but the fall from 22 to 23 was in part due to increase in production locally. We've also had basis widen out a little bit, and then rolling ahead to the 24-25 marketing year, that market year average price is looking more like 1070 compared to a high 11 right now, or in 23. So a little bit more or diminished expectations on the soybean price side compared to corn. If we look at prices for crop insurance, the price levels expected, here's the projected prices from late last week. So you've got corn, for example, down substantially from a year ago, the same with soybeans and the wheats. So those lower prices should mean it's less coverage that will be available, but the premium would be lower from the price standpoint. The same with the volatility. The volatility depends a little bit on what you talk about. So you can see for winter wheat, it was substantially lower. For spring wheat, it's down at the moment compared to a year ago, and it's up slightly for corn and soybeans. So it's not a huge high level of volatility on corn and beans right now, but up a little bit compared to a year ago. For the most part, for the volatility, when the volatility is low, premiums are low. So volatility is high, then crop insurance premiums are high. And I did want to take a snapshot look at corn and soybeans. I guess I have wheat layered in there too, just showing what happens to the implied volatility. Here's a snapshot over the last 3 years. So we've got a big spike back here. That's when Russia invaded Ukraine. Then you've got production giving smaller spikes during the summer. So last summer, a little bit of a spike. And then now here for corn and soybeans, you can see we're down below 25% volatility. And that's not crazy low, but it's not a high or shocking level in any way. That volatility comparison is up for anybody to take a look at on the CME website. So just search around for the CVol, and you can make a chart like this too, which I've found handy here this time of year. As far as crop insurance decisions, the crop insurance product choice is the first choice producers have to make. The dominant one last year and most recent years has been for corn and soybeans, revenue protection. It's just been the choice. It gives revenue coverage, and you have upside at harvest if prices were to increase, giving good coverage, good protection for anybody doing any kind of forward pricing or marketing. That breaking apart that a little bit, you can see that one thing that jumped out to me, you've got some use of the ECO and SCO endorsements, and then on on about 10% of the South Dakota acres, there was margin protection used as an endorsement. The last couple of years, that's gained a lot of gained in popularity, and that fixes or gives you some protection against things like fertilizer, fuel, and interest rate changes going forward. So just an awareness piece there. As far as coverage level, last year on corn, and same with soybeans, corn, most of it was insured at the 75% level. That it's a good balance between the level of coverage and the subsidy amount. So you've got a little incentive to back off on the coverage level from the subsidy standpoint. And then might also reflect just the fact that it's easy to become complacent. So should it be 75% every year? It should probably be looked at every year, even though it tends to fall out that way. A couple other things related to insurance. Here's just a look back at the last 10 years of the basis on corn, South Dakota. At the time, the crop insurance is settled, so it's cash price in October relative to the new crop price at that time. And then I just put an extrapolation out there for 2024. So it'll give you some idea of about a 35 under basis to be expected. I don't have it as wide as it could be, but it's not as narrow as it's been, because I wouldn't expect to have another tight crop situation or another tight supply situation. So I've widened the basis a little bit there. Same with soybeans. After several years of very tight basis, that's not the case at the moment, and it wouldn't be expected if production increases in 24. So looking at about a 60 under basis for planting purposes for soybeans. And the last thing related to those two, Jack alluded to this too, but there's been a little bit of talk about the soybean to corn ratio. Taking the South Dakota, taking the futures prices rather during February. So this is a comparison of new crop soybean to new crop corn price, and relating that to the March prospective plantings for South Dakota, specific to South Dakota, the soybean to corn acres ratio. You can see that there's a pretty good pattern over time between that price ratio and what producers report to NASS for prospective plantings. What does it mean for this year? Well, currently, if we take and compare the price ratio to the prospective plantings, the current price ratio is about 2.5, or soybeans are about 2.5 times the price of corn on the board. Come up here, take a left, come over here. We'd expect to see about 96%, or expect to see soybean acres to be about 96% of corn acres based on the current prices in the March prospective plantings. That's what I have. Here's my contact information, email or phone if you prefer. Happily take questions or calls going forward. And that's what I had, Laura. So if there's anything else.
Great, thanks, Matt. John, if you could launch the poll quick. I don't see any questions in the Q&A right now, but while we have the poll up, maybe I could ask a quick one. Can I get prerogative of the moderator here? You talked about feed consumption or feed use in corn, the differences between LMIC and USDA. What do you think? Do you think there was a role for the climate we've had over the winter? We're looking at record warm winter here, at least in the north central states. Do you think that has a factor that maybe has or has not been accounted for? Just a question from a climatologist.
Yeah, it could be. It would be an excuse for. Well, I could see it going both ways. I mean, you could say the weather's been good, so there hasn't been as much grain units needed, if you want to think about high energy crops needed to maintain animal weight, for example. But then you could also, so that would be saying less feed would be needed. But you could also, and I guess consistent with that too would be if weather conditions have been really good and you've been able to do more residual grazing and things, that's less supplemental feed, and that would mean less grain consumption too. So I guess both point to less grain consumption in a mild winter rather than more.
Mm-hmm. Okay.
That's how I would read it, but I don't think either group took that into account based on when the different sets of estimates and numbers came out. And it's tough to predict the full winter, from December or something like that.
Okay, sure. I don't see any more questions at the moment, so oh, just a second here. Let me make sure I got the right thing.
Of course, I'll take prerogative too. So take it
and go ahead and put that thing up so
yep,
folks can get their
yeah.
Oh yeah.
Go ahead,
sorry.
Jack. No, go ahead, Jack. You can talk. So
yeah, I'm gonna pick on you, Matt. Or question. Basis is quite a bit wider right now than
yes.
what you were predicting. So are
Well,
they
and
just
I'm
are they just trying to
extrapolating
take advantage of it?
No, basis is wide right now, and then you have to ask what's basis going to be like when new crop comes in.
Sure.
So I mean, we're comparing two different time frames. This is strictly new crop basis that
Yeah,
I was
and
showing. So
I was looking at bids for a new crop right now.
yeah, and it's going to be, it's going to be if I'm an elevator, I'm not going to be offering. I'm going to have a wider basis out there this time of year. Yeah.
Sure.
So, but I'm just saying it's like that's
Yeah.
an expectation versus a longer trend or a reality
Sure.
type thing too. Yeah. So I would expect basis to be a little bit narrower on soybeans than it's been from a demand standpoint, and then but the problems with all the shipping export markets right now is just doesn't seem to be any real end in sight for the Panama Canal, the Suez Canal. That just makes things difficult.
Thank you.
All right, thank you. I'll take down the QR code now. Thank you everyone for tuning in today for Crop Hour. Tomorrow, I believe, we'll be talking about fertilizer choices with a couple of our extension specialists as well. There's a link to our newsletters where you can see updated pest and crop information, and I put Jack and Matt's emails in the chat as well. So thank you all for attending the webinar today, and it will be available on YouTube later as a recording. See you next time.